Hello and welcome to the Aim High podcast. I'm your host, Bud Evans, and today I'm excited to have Stewart Heath with us. Stewart is not just any CPA, he's a real estate investment enthusiast who has grown a substantial portfolio by applying a meticulous, numbers-driven approach to property investment. Today, Stewart will share his insights into how a strong foundation in financial strategy can significantly impact the success of real estate ventures. Hear all that and more, where we provide real estate investors with the tools to achieve generational wealth. Let's aim high together. This is episode 82.
Hello and welcome to the Aim High podcast. I am Bud Evans, and today I am with Stewart Heath. How are you, Stewart?
I'm doing great, Bud. Thanks for having me on.
Stewart, you're the Harvard Greats Corporation. I could go through that. I'm just going to let you introduce yourself. If you wouldn't mind, give me like a 5-minute down and dirty on who exactly you are.
Yeah, nothing too exciting. I'm just an old CPA who discovered originally actually the oldest way to invest money in the world. I just discovered that I had a love for real estate about 20 years ago and have done okay with it. Yeah, I had some ups and downs back in 09 and 10, learned a lot and coming back and applying what we've learned. And we've grown our portfolio to about $20 million at this point with about $10 million in acquisitions in the pipeline that we should close in Q2. We're very excited. Like I say, I'm a CPA. I take a down and dirty numbers approach to real estate investing. That's why I like it, because you can boil real estate down to numbers and with interest rates and cap rates and occupancy rates and stuff like that, which you can't necessarily do with other types of businesses. I believe it's the best. It's the foundation of every portfolio, and it's the best place to start to invest.
Yeah, I'll agree with that. I invested in stocks and mutual funds and did the whole thrift savings plan in the military. And the one thing that I realized was the closer that I got to retirement it was not going to be able to sustain me for it. So I was going to wind up having to get another job. But at CPA, how'd you jump into real estate?
It's an interesting journey. I came out of college in 1985. And the very next year, my first year in professional life, under the Reagan administration, they passed the 1986 Tax Reform Act, which was revolutionary and monumental and actually set the stage for a lot of other bad acts to follow. But what they did in that was they retroactively, so they passed this act in October of 1986, and then retroactively took away some deductions and benefits of real estate limited partnerships back to the first of the year, and devastated some people's investments and really put a hurt on the apartment community that were primarily the assets funded by real estate limited partnerships, but also others. And so I come into my infancy as a professional and thinking, oh, real estate's bad. It's a bad investment. And I would sit around tables with bankers and we don't do real estate anymore. I said, oh, now I think about that. Oh, you'd much rather put credit on things with wheels and collateral that can go across the country without you knowing it. And so it took me about 10 years. After about 5 years of that, I left Price Waterhouse, the firm I started out with, and I started my own firm. And I just had all of these clients and they were all in real estate. They might be a realtor who was doing fix and flips, or some other small business owner who also loved real estate and had a portfolio. And it finally dawned on me, probably around 98 or something like that, that these people are getting rich. Yeah. They're not getting rich quickly. And it's not without its ups and downs and hassles and stuff, but they're building serious wealth. And so finally in 2000, it was the middle of tax season, and I'm taking a break at 2:00 in the morning, and I'm watching this infomercial from Carlton Sheets. Maybe you remember him. He was the original no money down guy. And you know what? For $199 money back guarantee, I bought that thing. Again, in the middle of tax season. I'm making good money, but I'm not building wealth. I had a very nice living, nice house, beautiful family and kids, but I knew I was not building wealth. And so I bought this thing and I started listening to it. So this guy's right. And so I went out following his procedures and I found an old crappy duplex not too far from my house. And I negotiated a no money down deal. And in the process of it, I started to realize, oh, I love this. Uh, I, I liked being a landlord. I liked relationships with tenants. I like doing a deal. And I even like doing handy things from time to time. I I don't do very much of that unless I'm just right there and I know I can fix it. But anyway, from there, I bought more duplexes and more properties. I even got into home building for a while. That was a mistake.
Yeah.
Awful lot of work. Totally respect home builders. They deal with a million details, and there's absolutely not enough profit in it.
Yeah.
There's absolutely, if you boiled it down to $1 an hour, they're probably making $25 an hour.
Stuart, I do have to ask you though, because it seems to be the new sexy ground up, rebuild, buy and hold.
I think if you've got a contractor that you trust and can deliver, I think that's a great investment.
Yeah.
Because the
Okay.
thing is, when you get the brand new property, your maintenance costs are almost nothing for 10
Right.
years.
Yeah.
And that's, yeah, I guess you're referring to the build to rent movement that corporate America is in love with right
And
now.
Chris Crone and guys like that who are coming out
Yeah.
now. I just saw an interview with him where they were asking why he's not jumping into commercial space. And he said that his ROI per unit is higher with the quads that he's building. Two side by side duplexes is what he's
Yeah.
doing.
Yeah.
That-
I don't doubt that. Although I've yet to see the residential property, except maybe a multifamily, 200 or 300 unit multifamily that compares to what we do
Yeah.
in our self-storage units, which is very much like multifamily without the toilets.
Yeah.
A- And, uh,
Right. And without
yeah.
crazy tenants calling you for a sink.
Oh, they still cold, but we could say, can't help you.
Yeah.
And when you need to get them out, it's a 2-week notice and they're out. So,
Nice.
yeah, we like storage. But interesting, I read this week that there are about 6 states that are contemplating bills to prohibit the corporate ownership of single family homes. Well, there's some risk there. Not that anybody already owns anything, I'm sure, but I've always been a little bit leery. I didn't want to have a big holding of that because
Mhm.
I figure when Blackstone decides that they want out, they'll just say, "I'm selling Orlando."
Yeah.
They're not going to
Right.
say, "Let's sell 20 units." No, they're going to sell 1,500. Yeah, and then they'll impact the market for a few
Yeah.
years. So
I
that's
just
what
saw where they had just allocated another 10, like almost $1 billion for
Yep.
the purchase of real estate. So the market is alive and well. And when you see one of the big three buying, you buy.
Yeah, yeah, the market's alive and well. Yeah,
Yeah.
I
Speaking
it's
of which,
been very active so far this year. So
I know you're hot on office space. I I have a lot of people telling me right now that is not a good buy because they're looking at Manhattan, but you
yeah,
have a different opinion.
I do. I love this question. Here's my problem. My biggest problem is the financial media. I'm when I'm at my home office, I've got CNBC on in the background and whatever, so I can glance over and check. But they talk about the office market as if it's ubiquitous or global or whatever.
Right.
There's at least 6 different subcategories of office.
Mhm.
And to my knowledge, there's only one of them that's really likely to go through some pain and is going through pain, and it is Class A and downtown central
Yeah.
business district stuff, primarily in blue cities. And not to get political, but just to be realistic about it, it's not a problem in downtown Nashville. It's not a problem in Atlanta or Birmingham, or certainly not in Huntsville. They're not having their best days, but they're not going belly up. But those are the places. Medical office, I'll take all day long.
Yeah.
because your doctor is not going remote and he's not coming to see you. They have to have the places to keep all that expensive equipment. And so you're going to go see them. And they like really long 10 or 15-year leases with renewal options. And uh, we own a medical office building. We also have what I call suburban office. Some people would classify that as service retail. In both are accurate descriptions. But there are places where the tenants themselves, that's where they meet their customers. So they're consumer facing, dentists, insurance agencies, mortgage companies, in anything and everything. Yeah, we've got one up in Spring Hill, Tennessee. It's been full for 6 years, and and we had a vacancy last year. Somebody decided not to read. We filled it in 2 months with a nice long-term lease. And yeah, I think throwing everything into one bucket called office is a mistake. Whenever you generalize, it's always a mistake, no matter what the topic is.
Yeah. Let's talk about your first commercial property, if you don't mind jumping
Sure.
back into that, because I'd like to, basically bring you back and show how you got into it and how others
Mhm.
might be able to follow the same template. So let's go over that first one, if you don't mind.
Yeah. My first properties were like I said before, were residential
Mhm.
in nature, and that's how I got on the pathway to do commercial. I kept buying units and buying units, and at one point I had over 200 units, most of them duplex units, but still a unit of residential uh, units that we owned and managed. And I discovered that was the closest thing to hell on earth that I could ever imagine. People just aren't rational when it comes to their home.
Yeah.
And so I migrated away from that and did my first commercial deal really just in early 2022. And it was an office building. And it's the one that I'm just mentioning. But I had managed that building for several years. I knew all the secrets and ins and outs, and I knew the tenants. And, you know, a fair price, uh, and we still love that property today. Um, Started out with something small. It was $3.8 million, which is pretty inexpensive for a commercial property. Although people could, if they really want to go commercial, they could do some commercial condos and rent those, which is not too terribly different than doing a residential property. It's just that your class of tenant is likely to be a little bit different. A commercial condo, you probably got them within 2 or 3 miles of wherever you live.
Yeah.
Sometimes they look like houses, sometimes they look like retail properties, but you own a particular piece of it, and then you can run it just like a rental property and rent it to a CPA firm or a lawyer or a dentist or whatever. And that's commercial property, and you'll get commercial rates, and that's a great way to get started. I think I think it just yields better, and it actually wears better than most residential properties.
That I agree with, absolutely. And it's so much easier if you do have someone move out on you. It's easier to turn the property, not necessarily rent to somebody that quickly, but when you do get someone, they stay there for a long time.
Yeah, yeah, yeah. Office tenants they're like storage customers. They really don't want to leave.
Yeah,
Like
exactly. Because
just outgrow it.
right, and it's brand. So they get into a place, they get comfortable in that place. People come to them. They know they recognize that's where they do business and that's where they go to.
Yeah.
Now, everybody has the nightmare. So let's talk about the one that you look back and you go, "Oh man, I can't believe I did that."
Other than building houses,
Yeah,
uh,
we can go into that one too, man. Why? I,
it's
ground up building is not easy.
no, there's a reason it's a profession. And like I said, I've got nothing but respect for the guys who do it and do it well. I like to say they are better accountants than most CPAs
Yeah.
because they're really dealing with the details.
Here.
So I actually had a nightmare on my very first property, and I wondered several times why I kept going. So anyway, I bought this first duplex in the hood and no money down. I didn't have anything in it. And then the very first winter, pipes are freezing. When I see something wrong, I do not believe in halfway measures or anything. So yeah, for a property that I got with no money down, suddenly I was in it 7 or 8 grand because I ended up having to redo all the plumbing, both supply lines and drain lines in that thing. Fortunately, it's a small house. It wasn't that big of a job and it was 1 story. But but I was very glad I did it. And you do stuff like that and it's going to last a long time. These were old copper pipes. Some of the drain pipes were still old lead pipes and things of that nature. And there was a Section 8 tenant in this property when I bought it. And so you go into it thinking there's annual Section 8 inspections. Couldn't be that much wrong with it.
Yeah.
Boy, was I wrong. Yeah. So I ended up basically redoing that house from the inside out, new plumbing, had to switch out old fuses to circuit breaker boxes. And every time I turned around, there was 5 or 6 thousand bucks. But I will say, when I sold that property, I got a fabulous price for it, which paid for all of that. And because it was in the hood when I bought it, by the time I sold it, it was in this new trendy gentrifying part of a Nashville suburb. That
Yeah.
so it was
I
very
live there.
popular.
I know
But
that area.
uh, really good, really good timing.
Yeah. I did some time down at the Nashville Air National Guard with their RPA unit, and yeah, I know exactly what air. One year I went down at the beginning of my tour, and it was don't go into this neighborhood. And then 5 years later, I went back down to serve a little bit more time down there, and they were like, "Hey, you got to see this
Yeah,
neighborhood."
yeah.
Yeah,
Go to this new bar. Yeah, I know.
exactly right. Go get your hair cut and a shave down there. That's fantastic.
Right.
Yeah, I know exactly what you're talking
All
about.
of downtown Nashville now is areas that my parents wouldn't let me go to when I was a kid,
Right.
but it's all the trendy stuff now. So
Yeah, Section 8 is my niche, man. I like it, and I don't. It's just
I liked it outside of Davidson County. I did not like it inside. It was administered by the city of Nashville, MDHA there, and it didn't matter what you did. You could have a brand new spanking unit, and they were going to fail you for something.
Yeah.
And they would fail you for having a red stain on the carpet that was Kool-Aid and stuff like that.
Yeah.
So it just got to be too much. But I did it outside of the county, and it was a great program.
Yeah. Right. It just depends on the amount of bureaucracy that you're dealing with.
It does. It does.
Yeah.
Yeah.
So, just gonna ask you, why would you invest in real estate over anything else?
E. To me, I always come back. The reason is in the word itself. It's real. I'm like you. I have dabbled in stocks before, and I still have money in the stock market. And I find even there, I gravitate to dividend paying stocks, which tend to be more stable.
Mhm.
But real estate is more stable. It is, it's cash flowing i- if it's a stabilized property. Obviously, a brand new construction is not going to be cash flowing from get go, but it has that potential. But to me, I just understand it. It makes sense. We are all physical beings and we all have to physically exist somewhere. I do not understand AI. I do not understand crypto. I do not understand the virtual world or either. Yeah, I think one of Warren Buffett's rules of investing is don't do anything you don't understand.
Yeah.
So perhaps I'm a simpleton, but real estate is simple and it makes sense and everybody can understand it. Whether you've either rented or bought a property or think you get it.
Yeah.
And yes, occasionally it's a physical asset, so things will go wrong. and they have to be fixed. But that's why you do a really great inspection going in. But to me, I just think real estate, again, I'll pick on the financial media. They have taken real estate and put us aside and grouped us with crypto and art and whatever and called us alternative. And I'm like, no, real estate's not alternative. It's the original asset. And the real estate market worldwide is probably 10 times the size of any of the public financial market.
Yeah.
Because everybody has to have it. And we all have to exist somewhere. So it's really the basis of investment. Real estate. We still, even in our tech crazy economy since the year 2000, we're still a real estate based economy. And that's why everybody's so concerned about interest rates, because interest rates impact real estate. And real estate impacts everybody. Anything that has just such universal appeal, I think is a great investment. Some of the other investments, I like food companies, people who produce food.
Mhm.
Last time I checked, we all got to have food. They're not likely to ever run out of customers. And beyond that, then you want it to be operated well and stuff like that. So that's why real estate appeals to me. It's so universal.
Yeah, it's been going on since pre-feudal times. That's
Yes.
that's where the word landlord came from. It's an actual
Yep.
lord who owns the land that you're renting so that you can grow agriculture. You
Yep.
know, yeah, I totally agree. And as far as land, they're not making anymore, so it's a
That's right.
scarce resource and always will be.
Yeah.
Uh, the one thing that you said about Warren Buffett, he also talked about gold in his book Snowball, and if
Mhm.
you want to sit there and look at it in your living room, that's great. But what's it earning while it's there?
Yeah. It's a, yeah. I'm not big into the commodities.
Yeah.
I have parked some money there for a short period of time, expecting a movement, and been right a couple of times on that. But then once it's run up, it's time to get out.
Right. So, what's next, man? Where you going next?
We are continuing to double down on our storage. We love storage as well. And we got two deals in our pipeline right now. One of them's a fairly large storage deal in a suburb of Huntsville, Alabama, up on the north side. Fairly new facility that needs proper management. And then we've also, going back to office, we've got a contract on a medical office building down in Birmingham, which we're very excited about, with some really high quality tenants down there. And that one will be a cash flow generator from day one at 8+%. So we're excited about that. The storage deal is a bit of a turnaround situation, which is different for us. But since we are storage operators already, and we look at what the current owners are doing, which is essentially nothing. There's a standard playbook for how you operate a storage facility. You heavy discount to get them in, and then you raise the price. And you use digital advertising, you attract everything. These guys aren't even open on Saturdays and Sundays.
Oh,
And
wow.
it's like, I was like, hmm, no wonder you're got half the occupancy you should have.
So all you got to do is move in there and take over and create and fix the inefficiencies.
Yes, yes. Which kind of is our value add. I don't really like doing things like we're going to go in there and do a fix and flip for a apartment building. I've really lost my taste for my own hands-on construction work. And not to say that those aren't good deals if you've got the right operator in there, but we can add a lot of value by being great managers.
Got
So,
you. Great. All right. And I'm just going to ask. This is like we're getting ready to go into the soaring four, but this is a question that I ask every guest because there's always some kind of nugget of wisdom that somebody's going to throw out there. What is one thing that you can take away from as your wealth increased?
as my business grew, and again, I always go back to CPA, and I've worked with small business owners and entrepreneurs my entire career.
Mhm.
And I have a little bit of that in me as well. One thing that I had to learn that I wish I had learned earlier was to delegate. And there's a book by Dan Sullivan, Who Not How. And I love it because it's short and to the point. And so when you're looking at that next thing you're going to do as you're growing and getting busier and busier, that next thing needs to be done. You don't need to be asking yourself, how do you do that? You need to be asking yourself, who's going to do that? Because you're never going to scale if you keep trying to do everything. So
Right.
that's that. As I have built my wealth, that's the one thing. And it's uncomfortable in the beginning for sure, because you got to trust somebody. And sometimes you're going to trust the wrong people, but you just got to understand that is a cost of growing the portfolio, and you just move on and you find somebody else. But the answer is never, I'll just do it myself. So
Yeah, I fully agree. Between Dan Sullivan's book, Who Not How, and Michael Hyatt's book, I created a job description for an executive assistant, and he has been with me for the last 3 years. I talk about him all the time. His name is Ron, and he crushes it, absolutely kills it. And he is my who. He is also my integrator. Didn't
that's
recognize
great.
that when I hired him, but yeah.
Great.
All right. So thank you for that. That's a great answer. And yeah, delegation is difficult because they don't want to lose control,
Nope.
you know? All right.
I am
So
the
let's go
control
into the
freak.
scoring four. These are the same four
Yeah.
questions that I ask every guest who can help someone. Let me try that again. Let's go into the scoring four. These are the same four questions that I ask every guest that can help someone achieve new heights. What do you use to keep you motivated?
What motivates me is my faith and my family. I don't really need a lot of internal motivation. I just like getting out and doing. But I love thinking about the legacy that I'm going to leave my kids. a- And I try to involve my kids in the business as much as they will allow me to. But that's what, but you have to also build in an appropriate amount of downtime,
Yeah.
or else you will get burnout and then you won't be effective for anything. But those are my motivations.
Great. What is one thing that you learned that completely changed your mindset?
So other than delegation, it would be really how I approach investing is you make your money on the buy,
Mhm.
not the sell, because you don't know what the market's going to be when it comes time to sell. But you're absolutely in control of how or whether or not you buy a particular asset. So once I realized that and internalized that into my investment philosophy, it was it was game changing. And we put out a blog series once a week called Deals I Didn't Do, because there are far more deals that I don't do than the ones that I did. And then I just go through and say, here's all the reasons I didn't do it. Somebody else might do it because I can be wrong, but still, it's you make your money on the buy. Because if you overpay now, you can't guarantee on the market fixing that mistake for you. It might, but you
Yep.
can't guarantee it.
I love that block. That's a terrific example of what to do in a block because if you're putting that information out there, that is definitely adding some value to someone.
It is one of our most popular. Yeah.
So what tools do you
And,
use to
and,
keep
and what's funny is sometimes we put it up there and we always follow deals. So sometimes maybe months later, we come back and we buy that deal because we
Yeah.
got it at the right price.
I just had that phone call today. The seller backed out, wants to
Yeah.
try it himself. I said, yeah, he's got $160,000 worth of rehab on 2 different buildings. He'll be back.
Yeah, exactly.
Right.
Yeah.
So what tools do you use to keep you on track?
Tools. I use our whole organization uses a project management tool called Asana. It's very similar, been around a long time. So we organize each project, each property, and it comes with one time and recurring tasks. And I can have it on my phone, my iPad, my computers. It's everywhere cloud based. We do use Microsoft Teams to communicate internally, and externally, we will use a tool called Active Campaign, which handles all of our email correspondence. But we also have a texting plugin so that I can text our investors and other people through that. Looks just like a regular, it's just a regular text, but it stays in the CRM and it goes into our correspondence with folks like that as well. Other than that, I live and die by my email. But those are the ones that we use to run our organization.
Great. Very familiar with several of those. They're all fantastic tools. Now, I used to ask this question, what's one thing you would change if you had to start all over? But what I really mean by this question is, suppose today everything that you've done is wiped off the table. Now you still have the knowledge that you have going on, but what would you do to start now?
Interesting question. I have lived through that.
Indeed.
Eh, Assuming that that you've got employment and a steady source of income to support yourself and anybody so that's number one. It might be just get a job. Eh, but to rebuild, I would definitely go back and start pursuing real estate. I would start it all over again because whatever happened that caused me to lose everything, it was not the real estate's fault. It could have been the economy. It could have been something else, but real estate in and of itself, aside from how you financed it, is still to me the most fabulous investment alternative for a number of reasons. You can leverage it. You don't have to. You want to buy $100,000 rental property? You don't have to have $100,000. You need about $20,000.
Yeah.
And you get all the upside, all the growth on a $100,000 asset, but then all you got to do is pay back the lender the $80,000 that you borrowed. And so, and in that, it's an inflation hedge and so forth and so on. But yes, I would start all over again. I was back at square one.
What niche would you jump right into? Would it be the single family, residential multifamily? Would you jump right back into commercial storages, or how would you start?
I might be taking your question too literally, but I would think I'd probably have to start with a residential property because they're so easily leveraged. And I'm thinking I don't have any money to start with. Okay. But I would, as quickly as I possibly could, get back to storage and commercial. Yeah, I'd probably, if I sit here, I'd probably do 4 or 5 residential properties, maybe fix and flips, maybe to make some cash so that I can go get into the asset classes that I really want to be in.
Great. I'm just going to keep going with that because I'm curious to see how you exactly raise capital for these deals now.
Yeah. So we do what's called a syndication. We use Regulation D, which is a regulation of exemption under the SEC, which means I don't have to file at like a public offering. It's been around since the 1930s and it's becoming quite popular these days. But all that means is we form an entity, we put out an offering, and there's certain documents we're required to prepare and offer to every prospective investor. And we say, all right, here's the deal. And our deal usually goes like this. We're going to buy this property for $1 million. We're going to finance 60% of that, $600,000, which we're going to source and guarantee. We want to raise $400,000 from investors, which we're also going to be one of those. Usually there's a minimum of about $50,000. And that 400,000 will be called Class A. And there's usually 2 classes. So here's how the deal goes. We buy the property, we operate it, all the cash flow, it goes to Class A before any of it comes back to us, the sponsor. We're also going to pay you a preferred return on that. Right now we're paying 8% preferred return. So before I ever see a dime, Class A will have received 100% of its money back, the 400K, plus an 8% preferred return. Usually takes 3 or 4 years to get that back. So they get all the cash flow. Once that happens, then we go to a 60-40 split where the investors who now have all their money back plus a preferred return, they still own 60%, and the sponsor will start get kicked in for 40%. And then we go down the path together and continue to own and operate this property until it's an opportune time to sell. So to do that, we have to find accredited investors, which is a defined term by the SEC, which essentially is somebody who's had a couple $100,000 of earnings over the last couple of years, or a net worth over $1 million, not counting their personal residence.
Mhm.
So if you meet one of those two definitions, then you can invest in most Reg D deals, as so long as you've got the cash to do that. And the reg, there are some that allow non-accredited people. We use an exemption rule that only accepts accredited only, and they have to be verified by a third party that they're accredited. So that's, maybe I'm going into too much detail, but that's really
No.
how we go out to everybody on our email list, to our friends and family and the whole bit, and just say, hey, you got a great deal. And usually our deals are cash flowing. $50,000, you're going to get an average cash on cash return on that number of 7% for the next 5 years. And it'll be higher at the end than it will be at the beginning. And by the way, you're going to get some great tax benefits up front as well. And a lot of investors, if they've not heard of it, we give them some resources, and we send them to other sponsors as well to say, hey, just this is something you ought to look at, because I know you're not happy with your stock portfolio. And you can do this through your IRA, you can do it through other retirement plans, or you can do it through any kind of a vehicle, through a trust, whatnot. It's really not as complicated as it's made out to sound, but it is for people who are higher net worth. So
Great. And Stewart, if somebody wanted to reach out and get themselves on your mailing list, how would they do that?
easy. You can go to harvardgrace.com, or you can actually go to stewartheath.com. My name's there at the bottom of the screen. Navigate over to where our resources are. There are free resources for you. Join our mailing list there. You can even find my Calendly link. I would welcome anybody to book a call with me, because I can talk real estate all day long. And so just reach out, but absolutely join the email, the mailing list. Get those 4 or 5 free resources, especially the one that's questions you should be asking your passive investment sponsor. We're really proud of that one, and just welcome. We'd love to communicate with you, whatever way you wish to be communicated with.
Excellent. Stewart Heath, founder and CEO, COO, CFO, Harvard Grace Capital. Hey, and guys, you just got 20 years of experience discussing all this stuff. So I hope you took enough out of it. Stewart, again, thank you very much. I know you're busy.
Thank you so much, Ben. I really appreciate it.
It's my pleasure.